All right, today we are going to look at someone who has been interested in a whole life insurance policy for a long time. He's been talking to agents, trying to get the policy right so he could use it for what he wants to, but when we look at the numbers, they just don't make sense to him. So he's been reaching out to different agents, trying to see illustrations where if he puts a lot of money into the product, he can say to himself, this makes sense for me to move money that I have in cash into the policy because I clearly see the benefits. We're going to go through his example today. So, a little bit of information on him. He is 36 years old. He is in software sales. He also invests in real estate on the side, and he wants to do more of that. Ideally, he'd like to transition out of this and get into this full time because he has a lot of fun with it. So he was pitched on whole life insurance in the past. He was pitched on it by multiple agents. A recent one, though, had a heavy focus on infinite banking, which revolves around the idea of using a life insurance policy as a financing tool and really replacing working with a bank, which he was attracted to because he wants to use it for real estate. So if I build up the cash value to be a big enough balance, I can use my life insurance policy instead of having to go to a bank, which I have a lot more control there, which a lot of people are attracted to. So here's what he wanted to see initially. $30K per year for 10 years. This was very important. Minimum loss in the first year, and he wanted to get his money back as soon as possible. The worst part about any whole life insurance policy is the first year. We're going to go through how to minimize that upfront hit, but it's always the worst part. So here's what he was shown. $30K per year for 10 years. But he lost about $9,000 in the first year. That's about 30% of what he paid in, approximately. It also took him, in this case, a little bit more than 7 years to get his money back. Then after that, beginning the 11th year, he was shown continuing to pay $9,000 per year forever, which he didn't want that. So here's an example of what he was shown. This is actually one of the illustrations that he was shown. He forwarded this to us. Here's the funding, $30K per year through the 10th year. I know there's a lot of columns here. I'm going to guide you. So there's the funding. Over here is the cash value. So $30,000 per year times 7 years is what? How much would you have paid? Think of it, 3 times 7 is 21. So here, it's $210,000. That's when you get your money back. In year 7, he has $211,000. The year prior, if you do 7 times 6, it's $180K. He had $174, or about $175, less than what he paid in. So he gets all of his money back by year 7, and then he sees a gain from that point forward. Now, down here, he sees $9K per year, paid indefinitely, which he did not want to do. Now, he doesn't have to do this. However, I've got a thing whenever we look at illustrations or show them, if I ask to see funding for 10 years, and then you show me funding it for 10 years and then still paying a premium thereafter because you think that that's best for me, but I'm like, I don't want that. I want to fund it for 10 years. What's going to happen? I'm going to ask again, or I'm going to ask for it from someone else. My point is, it's important to listen, provide the requests necessary, and if we think there's a benefit to continuing to pay, show that in addition to it. Meaning I would show this with no payments, and then say, by the way, here's what it looks like if you keep adding money, because you've got that option to do so. What he saw, he didn't want, for a number of reasons. One, he didn't like the idea of paying that premium forever, but two, that was the big turnoff, the big hit up front, and also taking 7 years just to see a gain on the policy. He'll be over 40 years old by that point in time. So here's what he wants, and here's what we'll look at. A policy with a low premium. When you pay money into a policy, it can go toward your premium or your PUA rider. He had a $9,000 premium in the last example. He wants it lower. Then he wants to be able to add money whenever he wants. Instead of $30K per year, he wants to be able to do 50 grand per year. And maybe start off with a lump sum. And then, as we mentioned earlier, have as much cash value as possible so we can use it for real estate. So we'll look at 3 examples here. Let's start with what we just looked at, because this is where he started and what we wanted to compare everything with. $30K per year for 10 years. What we'll do here is set the minimum at $3,000 and the maximum at $30,000. Here's what that means. He wanted a low premium and then be able to add money whenever he wants. So with the policy that we set up, he can commit just to this, where he's billed for $3,000, might come out to a net of $3,300 or $3,500, but he's billed just for this, and then at his discretion, he can add more money into the policy. This way he does not feel like he's locked into or obligated to pay $30,000 every year. Make sense? Let's look at an example of that. Here's $30,000 per year for 10 years. On the left is what he's committed to. He gets a bill for this. This is optional. This is your paid up additions rider. This accelerates cash value growth. This does not. In the first year, the premium does not give you any cash value because it primarily satisfies the death benefit. So if we just want the bottom line, I would look at this, annual funding. So $30K per year for 10 years, first year, $26,000 and change. Do you remember what the first example displayed? He took a $9,000 hit. It was about $21,000 in the first year. Here, it's 26. When did he get his money back? Well, 30 per year times 4 years is 120,000. This column will show you your total funding. And there's your cash value in the first year. In the fourth year, $120,000. Then he continues to fund it. By the 10th year, he's got $350,000. He pays nothing in thereafter, but he can continue to add money if he wants to. Now, in his particular case, he prefers to maximize the policy for 10 years, use it for real estate, and if he really, really likes it and wants to put more money in, he said, I'll just get another policy. I get the benefit of being able to continue to add more money here because I don't have to go through expenses again. If you start over with a new policy, you do have to go through expenses again. In his case, he said, let's just maximize it for 10 years. That's what I really want to do right now. And I get, if I want to keep going after that, I'll just get another policy. No problem. So that was just meant to compare with what he was originally shown. Now let's look at the option that he wanted to see afterwards. Now that he sees he can have a lot of cash value up front, have an early break-even point, he says, show me what it looks like if we get a bigger policy, because I'd really like to target $500K getting into the policy. $50K per year for 10 years. That will increase the minimum to about $5,000 per year, but now I can fund a maximum of about $50K per year. So I'm billed for this, but I can add up to this. Make sense? You don't have to get the 500 in either. We're not penalized if we don't. There's your minimum. There's the PUA rider. There's the net out of pocket. Cash value in the first year. Break-even point, still year 4. So here, by age 45, he's paid 500 in. He's got about 585, pays nothing thereafter, and the cash value keeps on growing. The death benefit appreciates over time as well. Now he's got access to this big old line of credit that he can use for his real estate deals, because this is why he did it, where he can say, okay, if I've got just a bucket of $500,000 sitting there where I don't have to fund it, I love the idea of that appreciating without any risk. I've got the guaranteed rate, all the fun stuff, and I can use it for real estate deals. Borrow, repay, and I know it keeps on compounding for me. That's what he was primarily attracted to. Hope that makes sense. One more thing to look at. There's more. He said, okay, I see what I can do here. I like the idea of getting $500,000 into the policy. I've got a lot of cash in the bank right now. Can I have a policy where I fund $50K per year, but I start out with a big lump sum? So I've got about $250,000 that I could throw in there in cash. This has come from my job, just in software sales, and with some real estate deals. I've got excess cash. Is it possible, Steve, to add this in the first year, but I don't want to do it again, because I don't know if I can handle that every year, and then have $50K per year every year after that? Yes, you can. Now, the thing with this is some companies, if you have a $250K first year deposit, that's going to increase your minimum to $25,000. Some companies it won't. This is where company selection is important. We looked at one of the 4 major mutuals with him, which was Guardian. And a big reason why is what Guardian allows in the first year, we can illustrate 50 times whatever the base premium is in a PUA deposit. So it can pour extra money into the policy. After that, beginning the second year, the most we can illustrate, whatever the base premium is, 10x that in PUA payments. And that's only if we have a term rider attached, which I won't go crazy with the details today. We can talk about that another time. Or let us know in the comments below if you want to learn about that, and we've got videos we can post in the link. My point is, what we were able to do here is set up a policy where he still has the same minimum of $5,000, but he just dumps in 250 grand in the first year, and then the maximum thereafter is 50K. So he still wants to get the total of $500,000 into the policy. However, he doesn't have to go for 10 years now, which he was attracted to. Let's take a look. I love this stuff. It's so cool what you can do with a life insurance policy. And this is just the initial setup. When you start to use it afterwards, then it gets really cool. Anyway, here we go. So this is going to look the best short-term and long-term compared to the examples on the left. I'm just going to minimize those so we can focus on the main point here. So the minimum is still $5,000. $250 in the first year, $5,000 premium, $245 PUA. Look at that first year cash value. What's the hit in the first year? It's about $8 grand when you look at it, because that's just about $238,000. That's less than the hit he took with a $30,000 per year policy. That's just him asking questions and then us showing different products and options, really call it knowing the rules of the game, so we can maximize every dollar he pays in. We don't want money to go out the door to expenses. Yes, insurance companies are going to make their money, but when we know what to do, you can minimize those expenses. Everyone wins that way, long term. When you do this, the break-even point, check this out. It's almost year 2. He pays another $50 in year 2. Total is $300,000. He's got $296 and change, and he's positive by year 3. And by the way, he's committed to about $5,000 per year in this example. A bit more, because we do have term riders. I think it came out to like $7 grand or something like that. My point is, he's still committed to a minimal amount. He gets the 500 in by age 41. Look at that. And that cash value just rides over time. The last example, doing it over 10 years, you're at 585 by year 10. You've got a lot more because it's just compounding for you faster. So this is just showing different things we can do with a life insurance policy where the out-of-pocket's the same, and it's really just call it discovery around how to minimize expenses, maximize cash value, make sure the asset is set up for maximum value for start to finish. It's got a healthy amount of life insurance. Now we did this to follow IRS guidelines and prevent a MEC. We did have to have it this high, by the way. But by doing this, he's in a really, really good spot now where he's got this big bucket of cash value. If he wants to keep adding money to it, he can, but he's not required to. And he can use it for exactly what he wants, which is real estate. So I do hope that you enjoyed this video. I had a lot of fun working with this individual and putting this case together. If you have any questions, thoughts, comments, please feel free to leave them below. And as always, I hope this helps. Thanks so much.